First rates on your screen, we start a brand new month and a brand new week. That's truncated week, so Tuesday is the first day of this week. It's a shade of red, just a shade of red, not like a meaningful one. We may threaten to go below 19,500 on intraday basis, who knows. The breadth is looking much better than what actually it appeared, looking at where the handover on Friday was from. Now what do you want to look at? Well, one and only Vedanta. Stock is at a 52-week low. This demerger, well, the jury is not out what it does to unlocking of valuation in the long term, but in the medium term, it certainly will be fillip. So the stock is reacting and it is bouncing back. It could be a case of buy the rumor and sell the news. From a 52-week low with this kind of a news, at least you know that the company now hopefully will survive in terms of the debt, meeting the debt obligations. So 8 rupees higher or 9 rupees higher for Vedanta. TVS Motor reacting to dispatch numbers. You got Mahindra and Mahindra, which is reacting to dispatch numbers. Tata Motors, Escorts and Bajaj Auto numbers are just about okay. Maruti, month on month there is a decline, year on year there is an uptick. It is the SUV sales which are doing better for them, but it is the sedan sales which in a sense are acting as a drag. So Maruti net 68 rupees down. Vedanta, Hindustan Zinc, they both are of the same group. Soon you will have 6 more companies by next 12 months. So that in a sense is important. Now let's look at some of the NBFCs. They were the talking point today. Shriram Transport, Piramal. You actually could see some price action there, given that India's bond inclusion is something which is going to be having impact on the way how things would move, at least for the bond market. So Piramal, flat start. Shriram Transport, flat start. I think Citi has a report on Shriram Finance. The next 90 days it will outperform. And then you've got, let's look at AU also, where Citi again feels that it may underperform. Oil is down. What is happening to Asian Paints? Oil is down. What is happening to Indigo? Those are two stocks which will gain and ONGC will lose. ONGC on expected lines is down. Asian Paints on expected lines up. And you've got Indigo, surprise. I think it is down by 6 rupees. Avan?
Just quickly revisiting some of those auto companies, the total sales for Maruti at about have grown about on a year-on-year basis. Hero Motors sales have come in at about 5.3 lakh units. You've got TVS Motor, the total sales on a year-on-year basis, they've risen about 6%, and we just had Bajaj Auto, total sales at about 3.9 lakh units. So that entire cluster of stocks, yes, in the spotlight. Coal India, the September offtake is up about 12% on year to about 55 million tons. You've got UltraTech with their Q2 sales volumes. That has grown about 16% on year. And I forgot M&M as well as Eicher Motors, so keep an eye out on them. So it's been fairly positive when it comes to the auto sales numbers for the month gone by. Meantime, Bharti Airtel as well, the 5G subscribers have expanded to 50 million within the last year or so. You've also got something like a Granules. It's a US FDA approval for a blood pressure drug, so that's keeping the stock in the spotlight. Biocon as well, some launches, and yes, Nikunj flagged off aviation, so continue to monitor that, owing by where we're seeing jet fuel prices going higher by about 5%. First trades then, let's find out what our chartists make of the overall trade setup. Federal Bank as well in the spotlight on the back of the Q2 updates. Kunal, what's catching your eye on the screen?
So I'll go with the buy on ITC. I think that stock has come back towards a strong support of 440. And over the last 2 months, I think month of September as well as so far, the stock has been holding on to this level. So that's the first trade which I'd look to do at current market.
All right, Nuresh, let's find out how exactly you're reading the markets at the current levels. It is a downtick of about 0.5%, but you believe that it'll be capped around these levels of 19,500, 19,600?
So expecting a reversal from 19,450, 19,500 band, and some bit of a recovery across the globe as well. But stock specific, continue to like GAIL India, that has shown a lot of resilience in the last few sessions, and today also has opened up in the positive territory. So like it for a bounce towards 135 levels.
Gautam Shah joins us now, he's founder and chief strategist with Goldilocks Research. Gautam, good to have you back. Dubai se वापस आ गए? I can see the backdrop has changed.
Yes, indeed.
Okay. 20,000, it may be psychological, it may be technical, but so far has acted as a swift or a stiff resistance for the market. Do you think we have a top in place, at least in the short term, and that could be 20,000?
Morning, Nikunj. Yes, I think we had a top in place because you just had all kind of ingredients coming in together to suggest that the market did top out at that level of 20,200. We've always read in the textbooks that when you have madness on the screen and madness on the charts is when typically euphoria happens, and when euphoria takes place is when markets top out. I think that was a classical case last month with large caps, mid caps, small caps, all running away at the same time, with all kinds of talks on the upside. So I think 20,200 was definitely a short-term top, which might not be taken out in a hurry. The market, given the way it's corrected in the last 10 days, has just validated that view, and the evidence that has come up on the charts hasn't looked good. In fact, we've been maintaining a cautious stance for the last 7-8 days, and we continue to do so. I think from a Dow theory perspective, we still need a break below 19,500, which I think is just a formality. And if and when it happens, the market has the potential to lose another 4 to 5%, at least, if not more. So I think things have changed quite a bit in the last 4 or 5 months. Whenever there has been a correction, we've always said buy the dip, be a buyer, because I think the market will go on and make new highs. But this time we have not maintaining that stance. So our stance has changed quite a bit in these last 10 days.
So for those who are watching the show and for those who will watch it on digital, should they now be locking some gains if your advice is that the market, the path of least resistance is on the downside? Is it time to at least book 25% profits?
Absolutely, 25% or more. I think in all the stocks and sectors that have run up substantially in the last 4 to 5 months, I think one should take profits. And one should realize that suddenly you have just too many headwinds. I mean, look at global markets. They've corrected quite a bit. Look at US markets, European markets, Asian markets. Look at what Hang Seng has done today. So many world markets have actually seen a large correction in the last 10 days. That's not look good. We are getting closer to the assembly elections. We are getting closer to the general elections. Oil has been quite a headwind, and FI money hasn't been as strong as it used to be. And let's not forget the big underperformance of Reliance and HDFC Bank, two of the stocks where if you really compare it with the Nifty, you'll see that they are at 52-week lows on a relative basis. So these are not factors that are very positive, and I think the momentum will pick up on the downside below 19.5.
All right. What's the stance then, Gautam, when it comes to these stocks that have really powered up, the likes of the railway stocks, the defense stocks, which really boomed? Do you believe that, you need to be very selective when it comes to this space? Or now do you believe that the positive time or the party is really over?
I think the party is either over or close to getting over for most of these stocks and sectors. A lot of the basis was on the Excel sheet over the next 5 to 10 years. But, when trends turn abruptly, it happens really, really fast. And I think a lot of these stocks went through a parabolic move in the recent past. So I think railway and defense clearly are spaces where one should take profits. And, we are focusing on stocks which have quality institutional interest, because let's agree to the fact that there is still a lot of liquidity in the system. Domestic liquidity is coming into the mid caps and small caps. So fund managers in the mid cap, small cap space have a lot of money to actually commit in their own stocks. So I think what we are focusing on right now is committing into stocks with quality institutional interest, quality fundamentals, great structural stories, which I don't think will be impacted if the markets were to correct. But on a general basis, on an overall basis, mid caps and small caps, one should be aggressively booking profits here.
What could be the duration of the decline? Could it be a multi-month decline? Could it be just a bad patch which happens in a bull market, swift, sharp, before you realize correction has started, it actually over?
It doesn't look of that variety, Nikunj. You and I have seen markets over a couple of decades, and every time this market tries to do something new. In the last 5 months, it was always a quick decline. So that bias is there in our minds that this time also something similar will happen. But when I look at the leadership, I clearly see it missing. We released our big picture report, a 47-page report yesterday describing the long-term trends. And if I were to just go by that, I feel that this could be a multi-week, maybe even a multi-month kind of a consolidation stroke corrective phase. So broadly, in terms of numbers, I think if we are able to stay in that 18,900, 20,400 kind of a band, and say till Diwali, I think we would have done very well for ourselves. But I do believe at some point of time, we could test 18,900 and possibly even 18,400, 500.
Not of the view that we could see a pre-budget or a pre-election rally, because that has always happened.
Well, things change. In fact, a lot of smart money have been putting this question that should we actually take on the assembly election results? And I think a lot of people want to get cautious before that. So I don't think you're going to have any sort of pre-budget or pre-election rally. I don't think this time it's pretty much different. And let's not forget, we still live in a synchronized world. Till a month back, world markets were all positive or range bound. Then the Dow is now close to a multi-month low. The S&P 500 has stopped outperforming. The Russell 2000 in the US is actually near a 52-week low, despite all that we talk about the US markets. And European markets and Asian markets don't look good. So in a challenging global environment, global equities environment, and with oil continuing to rise, and I do believe NYMEX crude will move towards 104, given all of these factors, it doesn't seem as if the market will see a bump up very quickly.
Okay, and let's get in your view then, Gautam, as to what you believe is looking attractive as a buy right now. From just a stock-specific angle, if you were to pick out some of the large caps, where is it that you'd be betting on?
Well, I think we moved to the defensive. So we love IT. I think we've been a big bull on the entire IT pack for a while now. We maintain that stance. And I feel in a difficult market environment, IT will stand out. And this 31,000, 31,500 area is an important support. Secondly, I think the sector that we feel could make a big comeback is pharma. I think it's very clear looking at Friday's action that the market has got into risk off mode. For the last 4 months, we were in risk on mode. So everything and anything that was high beta did well. Now, I think we've moved to risk off mode. And I think pharma could be a sector that could lead the market move from here in terms of strength, sectors doing well. And I do see the pharma index appreciating 15% from here. So our working target is about 17,000. So these two spaces look great. And autos, I know it's considered high beta, but if you really marry in the fundamentals and the technicals, I feel auto has the potential to be the big structural story for the next 6 to 12 months as well. So every small dip is a buying opportunity there.
Gautam, the entire engine or the propeller of this market are banks. Now, banks have not participated. Now, the technical theory is that the weakest sector would always lead the decline. Bank, which was supposed to be the strongest outperforming sector for 2022, has turned out to be the weakest sector. So could it be the banks, surprisingly, they actually could lead the decline because technically that is the setup?
Nikunj, the writing is on the wall. Banks will lead the market down. I think they are a big heavyweight. HDFC Bank, despite all that is spoken about fundamentally, has been one of the biggest underperformers, not just for the last 5 months, but for the last 2 years. And as I just said earlier, the chart of HDFC Bank divided by the Nifty has actually seen a breakdown last week, and this underperformance is not going to end anytime soon. In fact, Bank Nifty is probably one of the few sectoral indices in the market to not a new lifetime high, while the Nifty went to 20,200, while the mid caps did well, while many other sectors in the market did well. That to me was a big red flag. And now it is coming back close to the lower end of the range, which is around 44,000. If that were to break, I think 2,500 points could get shaved off on the Bank Nifty. So apart from the PSU banks, the top quality PSU banks that we still like, everything else is an avoid.
Okay, that's quite interesting. Gautam, as a theme, what one has seen is that across the board, PSUs are the ones which have been in the limelight. And I'm going to keep the banks out of this list. Your PFCs, REC, NTPC, this entire power pack as well has been at the fore. I can say the same about Coal India, and I can say the same about many sectors within PSUs. What's looking like a concentrated bet right now that even after the run-up, you can still go long on?
Well, sadly, you can't go long on not too many PSU stocks at these levels because, the rally has got parabolic, it's mature, everybody is talking about it. Fundamentals are pretty much understood, and it's starting to get a little over-owned. Now, if you have a 3-year view, I'm still very comfortable to hold on to PSU stocks because I think they'll do exceedingly well and they will outperform the benchmark indices by a wide margin. So in that sense, we love the setup of NTPC, Coal India, Power Grid, ONGC. I think it will do great things over a 3-year period. But if you're looking at the next 3 to 4 months, it might be a little challenging. So it might be more prudent to actually buy them on a dip. And in case the Nifty were to come down to the levels that we are talking about, you might get that nice dip coming in on the PSU stock. So long term, all good, very good. It was a breakout from a 10-year range, and that such breakouts do not end so quickly. Short term, little overdone, wait for that pullback, then buy an aggressive.
Okay, that's the view coming in on some of those sectors. And Gautam, what about when it comes to tracking what's going on within the entire auto space? Do you have any favorites? Would you be leaning perhaps towards auto ang?
So I think there are two ways to look at the auto index at this point. One is in absolute terms, and you might feel that in absolute terms it's run up a lot in the last 4 months. No doubt it's done very, very well. But in relative terms, the auto index has actually seen a mega breakout from a 4-year range, which is auto index divided by the Nifty. And I see significant upside in the auto space over the next 12 to 18 months. So I remain a big bull. I think Maruti will continue to do well. Tata Motors at some point of time will hit 4 figures over the next 18 to 24 months. M&M has a great chart structure. So I think TVS Motors, I think, has been right up there. So this entire basket looks great medium term, short term, but if medium term, long term. But if you're looking at short term returns, it's high beta. If the Nifty corrects, you might see some weakness. But on an overall basis, I remain a very, very positive on the entire basket, and the stocks which I mentioned, I would recommend commitment on any dip.
The other two heavyweights, Gautam, that I want to bring out right now, and they have completely been non-participative in this entire rally up onto 20K and beyond. Reliance and HDFC Bank. And what are you reading on the charts? I mean, when do we see a material move from both these heavyweights?
Well, you're not going to see a material move anytime soon. As they say in cricket, when the pitch is for 100 and if you're going to get out in 15 and 20, it means that you just don't have the potential to do well in the good times. And in the difficult times, obviously, you will get impacted. So we shared a chart in our big picture report yesterday where we highlighted that the relative strength charts of Reliance and HDFC Bank versus the Nifty is almost at a 52-week low. And I think this underperformance is not going to go away anytime soon. Reliance just keeps correcting from that 2,700 number. HDFC Bank, despite all the talk, hasn't really been able to see any kind of follow-up. And with what has happened in the last 15 days, I think it's going to get a lot worse. And the problem is both these stocks are supremely over-owned. So there is a case for a lot of selling pressure in these stocks over the next many weeks to many months.
Okay, but Gautam, then that's going to have surely a bearing on the Nifty as well, right?
That's exactly the view, Aisha. And I think it's all joining up quite beautifully, because when you have 40% of the market, when is the leadership? Reliance, HDFC Bank, ITC has pretty much done and dusted its uptrend. Banks in general haven't done well. L&T, I think, is very, very overbought at these prices. So when I look at the top 10 constituents of the Nifty, I don't get the feeling that we can make new highs in a hurry. So it does seem that over the next many weeks, maybe even many months, the Nifty just broadly stays in a range and digests the news flow around the elections and oil and global markets. Whereas stocks and sectors continue to do well. There will be pockets that will stand out: auto ancillary, sugar, infrastructure, power. There will be pockets that will stand out, unlock trade, hotel stocks. So concentrate on these pockets and not on the typical usual top 50, 100 names.
Okay, that's the view coming in. You're being very crystal clear as to where your preference lies, your view on the markets, and what the outlook is when it comes to individual stocks. A quick check-in as to what the market is up to at the current juncture. Well, circling around the 19,520 mark, the broader markets have flattened out completely. Names like ONGC, Eicher, Maruti, HDFC Bank, ITC, RIL, all weighing heavy on the index. In fact, let's find out the long-term market outlook as well from A. Balasubramaniam, who's now joining in, MD of Aditya Birla Sun Life Asset Management. Thanks so much for taking time out, Bala. Good to have you on board. And just what we've been discussing, that the heavyweights, the likes of HDFC Bank, Reliance Industries, have been non-participants, if you will, up until now. What exactly do you believe this indicates for the overall market?
First and foremost, I see the breadth and width in the market have been widening, going beyond the Nifty companies, which you have seen for the last 1.5 to 2 years. It's coming from the fact that as a country, I think we have been seeing a wider level of participations into the overall economic growth. Is coming from, one, a huge amount of infrastructure spending that is happening. And second is the good amount of Make in India theme is also now creating new industries in the country. Therefore, we have been seeing an automobile industry as a sector also now beginning to do well, especially in the other than OEMs. That's why if you look at it on a broader basis from the market perspectives, the sector that has done exceedingly well, who remains the core component of the market of the country, I think they are going through a consolidation given the fact the name that you took, I think they've gone through a consolidation phase, and basis which I think they need to settle down before actually start seeing the future level of growth. And this is always a function of market. We have always seen historically that we'll always see sector which have given significant outperformance go through a consolidation and does underperform, and then actually again catch up. This is a catch-up game. It always happens. I would assume it's part and parcel of that game rather than having any negative view on any of these stocks or sectors.
Bala, we had Sanjeev Bhasin of IFL, and he was talking about that one good stock to buy for next 1 year. Can you guess the name? Which one did he speak about?
I didn't see him.
Okay.
I didn't watch him.
Aditya Birla AMC. He's of the view that the worst is behind AMCs and now the market share gains and the commission structure will stabilize. Do you think that holds true for all AMC stocks also? Because today also we looked at Economic Times report where Tatas are looking at bidding for UTI.
Although I will not be able to make comment, especially to our stocks or in general from the equity market point of view. But I can only talk about the AMC industry in general continues to remain a core industry, given the fact that financial saving in the country has been rising and more investors would prefer to invest their savings to the mutual funds as we move forward. And the more players coming in, the expansion will happen. Existing players like us who have an established track record, having through multiple cycles and having been a lead player in terms of thought leader as well as have a seriousness in terms of building both the business and as well as the customer base. Therefore, the large players will continue to have the little bit of strong footing from the point of view of building the business. The business will remain quite robust. And then, see, margin, of course, is a function of regulatory framework and changes. I think the way things are changing as it stands today, though it's difficult to make a comment in terms of what the roadmap as far as these expenses are concerned, I think very fact that we've been going up and downs is also there is an element of realization that industry is of course already working on thin margin. Therefore, how much one can bring. At the same time, alternates also have been emerging in terms of various products that customer want to choose, they can choose. And given this kind of fact being there for mutual industry, I would assume the industry will remain one of the core sector, both from channelizing its savings into the capital market point of view. Second, even from providing a capital for the needs of various companies, both in the fixed income and equity will remain one of the major provider of capital. Given the fact that we play a very larger role, I would assume this will become one of the key sectors as we move forward from the overall economic perspective, country perspective.
Okay, fair enough. And what's your outlook then, Bala, when it comes to looking at the overall fund flow activity as well? Given the kind of, sort of aberrations that we're seeing across the globe with respect to the bond yields as well, how are you looking at the liquidity situation into India?
As it stands today, liquidity is comfortable. Of course, we did see some the long holidays, which was there towards the month end, and again is the half-year closing. There was some bit of tightness. There was some bit of flurry of activities for raising deposits. But otherwise, liquidity in general has been quite comfortable. The Bank Committee has been quite clear about providing liquidity. From the flows point of view, I think people have increasingly got that feel that investing in equity market has to be largely through the SIPs, and that's something we are saying that SIPs continues to grow. And then net inflows industry has been pretty decent. And there was a flurry of activities in terms of even redemption, stopping of SIPs. We're already seeing it coming down in terms of the redemptions coming down and SIPs cancellation coming down, and the new registrations have been rising. I think this, in my view, will continue even as we move forward. I also have the opinion that given the fact that bond yields are also rising globally, especially the US bond yields have gone up and Indian bond yields are somewhere around 720. And we also see great opportunity on the fixed income space, given the fact that one general view that is coming from global market across all economies, across all fixed income investors, is the rate is going to remain higher for longer. If that is going to be the trend that we are going to witness for the next 1 or 2 years, when fixed income schemes right from the liquid funds, given the fact that it will have a carry of close to about 7.2% linked to the moral repo rate, the carry being better in the fixed income schemes, we'll also see allocation towards the fixed income schemes also increasing along the side of the current allocation that happens in the hybrid as a funds category. So I see the flows doesn't get reduced. But I think you will see some bit of split between equity and fixed income. Also, we see it happening in the next few months to come.
So, Bala, in terms of asset allocation, what do you do right now? Because, irrespective of the risk which comes with the small and mid-cap universe, the outperformance that they had in the run-up to 20K, and then since then, even now, the rebound that they are staging, case in point being what they did last week. Do you reduce your allocation to mid and small caps, increase to large caps, or vice versa?
I think it's interesting trend. If you look at the balance advantage fund, which is one of the fund which actually been focusing on allocation between equity, fixed income, and some bit on arbitrage as a category. At this point of time, given the fact that market trades around where they are highest level, at the same time the current valuation does not justify being overweight on equity. That's why I think the balance advantage fund, which we also manage, has got equity exposure of close to about 48%, and rest of it to bridge the gap between 65 and 48 is in the arbitrage, and the rest of them is actually the fixed income instruments. Given the fact fixed income also carry a better output from the investment point of view. I think that's the current view, and within that, our belief is it has to be a good mix of large and mid cap. Though there's a wider feeling which is coming that mid cap and small cap stocks have run up. Therefore, are we running any regular risk? We as a fund house have not taken that extreme call. And given the fact that breadth and the width in the market have been widening, the earning growth for some of these mid-sized companies have also been a bit better than the large cap names. So therefore, we still have a little good balance between large cap and mid cap. Even the balance advantage fund as their portfolio. And that's the way the portfolio is constructed. But given the fact that where the market, where they are today, given the fact where the interest rates are, where they are moving, and the other potential risk that is could affect the market. And the equity in the case of balance advantage fund, we are underweight at this point of time, close about 48 to 50%.
That's quite interesting you mentioned that, Bala. So should one increase allocation to fixed income versus equities? Clearly, is that the message?
I think should be part of the consideration, given the fact that higher for longer itself gives an answer for somebody to look for a better carry. And 7.5% or 8% kind of carry cannot be ignored, even the any scheme of thinking. Therefore, while equity has to be built for longer term, we need to be clear about there will be some volatility which is set in as we move towards election period, as we still seeing our equity market continue to outperform, then we will go through a consolidation phase. So keeping that in mind, also keeping carry in mind, I think one has to look at equity from a longer term investing point of view through SIP and STP. At the same time, look at fixed income also as part of the allocations in the overall portfolio.
Bala, thanks so much for taking time out and joining in, sharing with us your insights and outlook on the markets. And as things stand right now, it is the mid caps and the small caps that are seeing a mild amount of recovery, but by and large, the undertone of the market and the market breadth continues to remain fairly somber. Now down 0.6%. There's just FMCG, which is showing you a streak of green, but other than that, pharma, energy, metals, finance, not to mention the Nifty Bank Index is down about 0.5%. Just want to mark some of the movers as well within the broader universe that are feeling the heat this morning. And you've got the likes of an MCX, Eicher Motors, Siemens India that are down, KPIT Tech as well as Aurobindo Pharma that are under pressure. But of course, today is the key listing. That is what the street has been awaiting. JSW Infra, the first IPO from the JSW Group in the last 13 years. Sharad is standing by at the Bombay Stock Exchange in the midst of all the action and now joins in with the details. Sharad.
Well, yes, this is the first IPO coming from the JSW Group after 13 years. Now, the IPO is for the JSW Infra, and also the company is the second largest player when it comes to the private space of port operating. And if you look at the total subscription, that has come 37 times, and the IPO price, if you look at it, is at 119 rupees. Now, what's expected from the grey market premium is that expecting is there of a premium listing going ahead, and the entire management of group companies are also present in BSE, and the overall atmosphere has been very strong over here on the bourses today.
Right, okay, counting down to that one. Sharad, thanks for that. In fact, on that note, we're going to take a very quick break, come right back, lots more lined up on the other side.
It is परफेक्ट बैचलर पैड।
तो कब लेना है आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में।
मतलब अभी नहीं खरीदना है?
अरे अभी खरीद लिया तो ये घर भी उस फाइल में अटैच हो जाएगा, समझ रहे हैं ना आप?
इसलिए housing.com का हाउसिंग असिस्ट फॉर रेडी प्राइस मैच एंड वेरीफाइड बायर्स। housing.com, पोस्ट योर प्रॉपर्टी नाउ।
Welcome back. We just spoke about JSW Infra and the upcoming IPOs and listing. Sajjan Jindal was speaking earlier, and he says that the company has huge potential and that this is the largest issue from the JSW group, considering the time value and money. Listen in.
It's just the tip of the iceberg that JSW Infrastructure is listed. It has a huge potential. You know, we have such a large coastline, and not only that, our logistics cost is probably the highest in the world. The cost of transporting goods in India is the highest. So JSW Infra has a huge potential to grow its business, to create what like government has created Concor. So I keep challenging my team that why can't we create a second Concor within the JSW Infra? Is that a possibility? Why can't we create like Singapore, the ports, or you know, Singapore is a tiny city country and handles more cargo than all of India. So, you know, why can't we be that kind of a thing? You know, not only we have our own cargo, but we have countries around us. So we have to really think at those levels. We cannot think only India-centric. We have to think global, and we have to really build ourselves as a global, global country. But interestingly, this is the largest issue from the JSW group of 2,800 crores. So, you know, of course, the time value money, if you don't consider, then this is the largest issue till date from the smallest company of the group. So it's quite interesting that how things have changed.
Okay, let's also hear it out from Vikas Khemani from Carnelian Asset Management. He believes that India cannot have a story going without L&T benefiting from it, and which is why this is his one long-term buy bet.
See, if India economic growth story has to happen, if India investment cycle has to happen, L&T is the flag bearer of that. You can't build India without L&T benefiting. India L&T is present across all segments, whether it is hydrocarbons to infrastructure to industrials to everything, residential, everything. It's kind of broadly defense. Everywhere it is kind of positioned well, and all these cylinders are firing. And more important, in last 5-7 years, management has worked hard in terms of getting their capital allocation right, focusing on ROC, and also they have created fabulous business in terms of IT services. So the company has got transformed, over last decade or so, and in the recent past, focus on capital allocation. So, and more importantly, I think the investment cycle in India and in Middle East, where L&T is very strong, is picking up in a big way. So it will remain beneficiary, according to us, in the foreseeable future. At least I see for next 3 to 5 years, nothing changing, negatively for the sector and company in specific. So our idea is to remain invested into structural ideas.
All right, let's get a move on then and put the spotlight on the company Carousel Group, which essentially manufactures sinks. We've got with us the management, which is Chirag Parekh, who's the chairman managing director. Thanks so much for taking time out. Now, given the fact that, quartz sinks constitute about 15 to 20% of the total kitchen sinks in developed nations like the US and the UK, can you share your insights as to how you can leverage this market share, how you can look to further expand?
Yeah, thanks for having me on the show. I think last time I said that the granite sinks are the fastest growing category right now. Globally, it's not just India, but it's globally. You would be surprised to hear that the last data what we have is that the most of the developed nations like Germany, UK, they have started having more than 50% market share for the granite sinks. While our strategy has been now to globalize our brand, so we are right now focusing on the product expansion as well as market expansion, and we want to leverage this across the world.
Broadly, how much of your business you would say essentially is coming from the organized versus unorganized market, and how much is coming from tier 1 and tier 2 cities?
You are talking about India or globally?
Globally.
Globally. So I think first of all, we do not, I think we have a premium product. So I think we don't have any kind of unorganized market. The most of our revenue comes from the Europe, UK and the US, which I think constitute about 65% of the revenue. And then balance is obviously India and, Asia. Coming to the, so I think, most of this developed nations, I think they all have mostly have the tier 1. But I was particularly talk about India is that the tier 2 and the tier 3 market is substantially growing, and we have seen a huge upside on it. So as far as India is concerned, most of our galleries expansion are happening in the tier 2 cities.
The other thing, Chirag, is that what one is reading from all the channel checks, India is where the property market is in a boom, right? So just wanted to understand whether you see your domestic share actually increasing far more than exports.
I think it's a no-brainer the way India is shaping up. I think we're very confident, very bullish. Yes, we have been a predominantly export company, but I think we are changing our tracks. I think the next 5 years are going to be very India bullish. Hence, I think in the last interview that I had mentioned that we are coming with a range of products. We're doing a great product expansion. We are building up our brand building capabilities in India. We're also putting up a new manufacturing units for the built-in appliances and for the faucets in India. So I think we are looking at a great India story moving forward.
Okay. Could you broadly tell me that what are the trends which are there in terms of this entire kitchen upgrade cycle which has happened? Because you are a play on kitchen upgrade cycle. Indians first upgraded their floors from marble to tiles. Then they upgraded their bathrooms, from, variety of things were there. Now the kitchen upgrade cycle is moving. How real is this, and how will you benefit because of this?
Yeah, sir. Nikunj, very good question. I think this lifestyle thing has changed after this COVID. We have passed through this COVID wave. Especially in this Western countries, you have a change of a sink every 4 to 5 years. Hence, the demand of the kitchen sinks are very high there because they change their kitchen sinks and the platform every 4 to 5 years. We've been seeing a lot of this happening in India. While in this COVID time, a lot of people are spending at home, and even now that's in the culture, it's still there. A lot of people want to work from home culture, so they want to have a great kitchen. Plus, you're talking about the Gen X and the Gen Zs who likes to be at home, wants to throw parties at home. So they have been focusing a lot on the kitchen, not for primarily India, but for the bathroom, because we still have those kitchens who are on a closed door behind your dining tables. I think that trend is gradually changing. People are giving a lot more focus to the kitchen products, and that's why we see a huge wave coming up, more on the lifestyle change in India.
I wanted to also get in some insights from you as to how you're looking at the transition in terms of outsourcing chimneys and hobs, because that makes up 60% of the company's appliance sales. Given that there were plans to invest in phase 1 and 2 for adding 1 lakh units in each phase, how are you looking to handle that transition?
Yes, built-in appliances, we see big demand coming up, and I think it's the most promising segment. We have great margins there, not just for India, for the exports. We want to leverage that through our exports distribution also. We are starting our phase 1, which is going to be coming up in Q3. We're starting at 100,000 units, and then we're going to later on we're going to build capacity for another 100,000 units, which is going to be primarily built for the kitchen goods and the hobs.
So is it a tall order for you to get to 1,000 crore in FY25, or this is a realistic number?
I think at the rate what we've been going, the new plus strategy coming into play, which I had said last time, Nikunj, that our 80 to 90% competition comes from Europe, primarily from Germany. So when the costs are rising high out there, we have a lot of, there's a huge shakeup globally. So they are all looking at India to source, and with the shock technology. I think we still are the only third license in the world who has this technology. So I think, yes, I think you'll be able to see moving forward in our next quarters, but we are very confident that with our opportunities lying ahead and what some of the deals we are planning to crack, I think this is going to pretty much put us in the range of 1,000. So we are quite confident to hit this 1,025.
Chirag, great to have you on the show and good luck with the businesses. We'll chat again soon, and I'm sure the festival season up ahead as well is going to only bring in more fervor for your domestic sales at least. On that note, we're going to take a very quick break. When we come back, the JSW Infra listing. First trades right here on ET now, and along expected lines, the pre-indicative rate for JSW Infra is indicating that 20% premium to the issue price. We are awaiting to hear more from Mr. Jindal, and then of course the listing as well. But in the meantime, let's welcome on board. We have with us Rajesh Sharma, MD and CEO at Capri Global Capital, joining in on the show right now. Rajesh, hi, good morning. Good to have you on the show. As I can see, your AUMs have grown a solid 61% in the first quarter as well. Has this momentum continued into Q2 too?
Oh yes, Q2 is always a better half for all the lending institutions and NBFC housing finance companies. So I think our Q2 is also going to be good, and beyond that, if you talk about second half, I think that is going to be even better. The demand is good, and on the back of our expansion of branches, this year we added last 1 year we added about 700 branches. So I think on the back of that, we are looking for a very good growth numbers.
So, given your vision to triple the AUMs in the next 5 years and the kind of growth that you're currently seeing, are you going to only up this target, or do you think you'll be able to achieve, the targeted numbers before even 5 years?
I think at the moment, let us keep what target we have set. Of course, we will try to deliver better than what we have said. And the way the Indian economy is looking, I think we are quite excited about the growth and kind of opportunity lies ahead. I think Indian economy in MSME segment, affordable housing, gold loan offer the massive opportunity looking at the overall demand we are seeing in tier 2, tier 3 town. So we are quite optimistic, and back of that, we have expanded so rapidly. We intend to add another 150 branches in the next 6 to 9 months. So expansion is continuing.
Right. What segments do you think that are going to actually lead to the growth numbers and the kind of robustness that you are seeing across the board?
So as far as capital is concerned, we are into MSME, affordable housing, gold loan, and developer financing. 80% book represent the retail segment, where the ticket size in MSME is about 17 lakhs, home loan is about less than 15 lakh, gold loan is about 1 lakh rupees. I think these are the three segments where we are catering the same kind of customers who are not catered by the banking system because of the informal their paperwork, and plus the very high cost of delivery of the credit by the and the very multi-layer credit processes. So I think that is where we have built our expertise, understanding the local market, devising the underwriting policies for each regional market separately. And out of that niche, I think we are going to grow. We see a massive opportunity in these segments where banks are not catering to.
All right, you got a new listing. Mr. Sharma, just stay with us. We'll just come back to you. You got a new listing today, and that's from the JSW Group. And there you go. I think you can see Sajan Jindal, you can see his son, and well, it's the first IPO from the JSW Group after a gap of nearly 10 years. After a gap of nearly JSW Infra, the grey market premium was indicating that there would be a 15 to 20% kind of an pop-up start, and there you go. 20% higher for JSW Infra.
10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
All right, listing of the day, JSW Infra 147, much higher than what everybody thought. The grey market premium is substantially at a premium to what the initial issue price was. These days it takes just 3 days for a company to go to the IPO market, close and list. So before you realize the issue khulne wala hai, you realize that another email saying that listing ho rahi hai. So listing for JSW Infra has been solid. It has been robust. I mean, I'm of the view that don't be tempted to sell into the opening pop. This is a business you need to own and keep, let's say, for years, because it's a very strategic business. They get a lot of business from the JSW group, and also this is a business where, if manufacturing in India is increasing, if things on the manufacturing side could be a combination of both hard infra and soft infra, then some of these port businesses which are really virtual monopoly of that region, they tend to benefit disproportionately. But back with Mr. Rajesh Sharma of Capri Global. Mr. Sharma, if I look at data, which is about two-wheeler sales, what is happening to the rural economy, impact of monsoon, the agrarian economy and the rural economy is under stress. But if I look at the books and the retail credit growth, what Capri has reported, what banks are reporting, what other NBFCs are reporting, there is a solid growth. So one side there is a slowdown, and on the other side, banks are reporting solid expansion in the retail book. How are these both coexisting?
So what we see clearly on the ground when we are opening the branches, we are able to see clear traction demand of the loan, and also not on the loan, we are also seeing the good collection efficiency. So we are clearly see the businesses we are lending are able to generate enough cash which are serviceable. And I think if you look at the overall market segment of MSME, home loan and other aspect, there is a still large amount of gap exists. Still, there is informal lending happening through the pawnbrokers, or they do not get the sufficient money. So look at that side, we clearly see there is a massive opportunity still to bring them in a formalized lending system and to continue to help them to grow. So as far as these segments are concerned, I clearly see that even there are more players are required, there is a huge gap exists. If you talk about other aspect, I do not know the reason of the slowdown. But on the segment where day in, day out we operate, we clearly see that from 750 branches, even though we increased to 1500 branches, there is enough business to do. And when we look at the data given by the CRISIL, by the other credit bureaus as well, we clearly see that yes, segment to segment, there are growth opportunity. MSME talk about the mortgage-backed serviceable MSME segment exists to about 22 trillion rupees. And there's a huge gap exists still. If you talk about the home loan, affordable home loan segment, even the 2 to 3% more penetration is going to give a rise of a massive opportunity in the affordable housing segment. Now, only challenge currently we are facing and everybody is facing the rising interest cost and rising cost of doing business. If somebody is able to handle that with the technology, with the process improvement, I think next 5 to 10 years, all of us have a big runway to catch to these segments.
Okay. So considering that you've expanded in home loan, are there any other verticals you would be tempted to add?
At some point of time, we might go in digital lending through partnership initially, and we can twice. But at the next 1.5 years, we are going to focus only on the expanding the gold loan. Back of it, how to cross-sell our MSME and home loan through those branches as well. And see that once we acquired a 500,000 customer, which is currently about 300,000 customer, a mass is developed where we can do a lot of cross-selling. We also started cross-selling them the insurance and the car loan product. And we clearly see that this year, our car loan distribution alone will get us about 250 crore rupees of top line and about profitability about 70 to 100 crore. So these are the products we are adding along with our lending product. We are also adding the distribution product. There, purely fee income we are able to get on the back of our customer base.
And wanted to understand a little bit more about your financial metrics. When do you think the 500 crore PAT mark will be hit?
We clearly see this year, looking at, we should be around 350 crore rupees PAT. And next year, since all the gold loan branches we opened, we complete more than that 12 to 15 months, and they'll start contributing. So next year we should be somewhere around 450 to 475, and we'll try to achieve the 500 code in the 24-25. But definitely 25-26, we will definitely cross the 500 code.
What about the outlook on your cost of borrowings? Because that has steadily increased for you. And what's the expectation going down the line, given that the higher rates could persist? How are you looking at the cost of borrowings and your net interest margins?
So cost of borrowing definitely last 1 year consistently have grown, and that has shrunk our margin to some extent for the old lending what we have done. As far as the new lending, which we are currently, we are able to pass on the rate of interest to them because we have increased our reference rate of long-term lending rates. So I clearly see that maybe next 3 to 6 months, there should be now, rates should start softening. Even though that doesn't happen, so far demand is not affecting these increased rate of interest. That doesn't worry us.
It's great to have you on the show. Thanks for taking the time out and joining in once again. JSW Infra, that's the buzzer of the day. On its listing day, it's already made it a headway towards the 27% premium mark, I beg your pardon. That's where the stock is right now. So a solid listing at that along expected lines. For the rest of the market, though, I can't say the same. We're pretty much at the session lows right now. We're down a good 166 points actually on the Nifty futures alone. The key pressure points, of course, being, there you go, we're sub 19,500 actually. So the key pressure points continue to remain HDFC Bank, Reliance Industries, and the Nifty Bank overall as well, which is quite languishing, down about 0.7%. On that note, we'll take a very quick break.